All right. Welcome back. Hope you guys are rested, notepads are ready, because day three is going to be action packed.
Absolutely, guys. So, the first lineup on our speakers today is the one, the only Mr. Aaron Chapman with Security National Mortgage Company. He helps a lot of our investors get loans. He specifies in getting loans for investors all over the country and many other turnkey providers like ourselves. And he'll be diving into inflation and how inflation isn't what we think it is. It probably is a little bit more than what the Fed's reporting, and how that can actually benefit you if you're investing in real estate with leverage, because it's a hedge against inflation. And he'll be diving into way more details on that, on how you lock in today's dollars but still be paying it the same dollar amount on your mortgage over the years to come, even if that dollar is less valuable in 10, 20, 30 years from now.
Yeah, definitely. And then after that, after Aaron, we're going to have a testimonial from a current client. So you can just understand the story a little bit more of some of our other clients that we have. It's one of our favorite parts of helping our investors build portfolios for the future and getting close to financial independence is that we get to build deep relationships with our clients. And Zach is one of the best, that's for sure. Then next up, we're going to educate you on how to utilize the money that you have locked away in your retirement account and how to invest that money in single family turnkey rentals as well. And shockingly enough, it's a lot easier than most people think.
That is awesome. Yeah, and me personally, I actually have self-directed my one of my IRAs or a portion of it and bought into an apartment complex with some of our partners. And you can do that with single families or multifamily. Then, lastly, we will be deep diving into a property here, a B class property on Mill Branch in 38116 zip code. And we'll be doing a deep dive. I'll show you the before, during, and after of that renovation of that property so you can see what we're doing along with the finished product. Mark will be diving into some more stats and data on the property. What are the things you're covering there?
Yep. So I'm going to show you the due diligence vault. Basically, it's a Google Drive of all the marketing material that you need to make an educated decision to see if you want to invest in the property or not. So it's the pro forma, the scope of work, you'll have the pictures, a checklist, it'll go into some of the tax data, you'll have the home inspection report in there. And then finally, we want to bring Memphis to you. So we're going to drive you around the neighborhood so you can see what a B class neighborhood looks and feels like, as opposed to just driving around on the Google car. So sit back, enjoy your time on the sofa, and let's go dive in. Welcome, everybody, to the next session for the 2021 SOFIT Summit. I'm very excited and pleased to introduce our next speaker here, Aaron Chapman. Aaron, welcome. How are you today?
So, Mark, I'm doing very well as always, especially when I get a chance to chat with you guys and all the people that are watching, and hopefully they're not shutting it off because I'm jumping on.
Yeah, hopefully more people are joining because you're on and shutting it on. We love to have you on here. This is Aaron's been at every single one of our events to date. We're very proud of that. And Aaron is a true legend and guru in the space. We've done hundreds of deals, hundreds of transactions together. Aaron's actually one of the top lenders, not just within the turnkey space, but in the entire United States of America. And what we love about Aaron is just the incredible team that he's been able to build. His team of girls just absolutely next to none. And you know that if anyone has a trouble with a loan, needs any assistance, go to Aaron. He's the guru. He's the place to be able to fix it and make it happen. So without further ado, Aaron, take it
Well,
away.
thank you, brother. And you're right. I have, especially on the team part of it, I'm very, very blessed to have a badass team. And now there's dudes on it, right? So it used to be, a bunch of women in the team. It was awesome. But now I've got Scotty Bear, I got Mitch, I got Andrew, and think that's right. I think it's, oh no, I got Marquise, one of our underwriters, and Kevin. Crap, I forgot Kevin. I have 5 of them. So
Right.
5 dudes, a total of 32 staff members. So, when we were doing these before, it was, just slowly growing, but man, we've been blessed to see a lot of awesome growth. And my goal, just so everybody here, I'm going to put it out there public. My goal is to have 104 employees within the next few years, 104 staff members on my team, because, as you'd mentioned, us being one of those top lenders in the company, it's not just, us as the company itself, but me and my team. The average person in the industry that does what I do does between 2 and 3 transactions a month, maybe 4 or 5. We do about 7 a day. So this last 12 months is just a little over 1,500 transactions, and a lot with you guys out there in Memphis. And I think we probably are approaching maybe nearly 1,000 deals we've done together because of how long I've been working with the team out there. And there's usually a couple hundred deals a year, and we start adding that up over 5 years. Because I think I met with Jim back in 2015. So
We'll
you
throw a
start
little
seeing how that adds
celebration
up
when
fast.
we hit that 1,000 loan. I love it.
We probably already hit it, right? So we should be knocking some back.
I
That's what we
love
should be doing. Celebration should be coming. But thanks again for letting me on and let me talk to the group out there, because there's a lot of stuff coming out that I think that we really need to be touching on. If investors are pausing in any way or wondering if they should be moving forward, we should really be giving them some data to think on.
Perfect. Well, let's dive in.
So ultimately, what I see today is the biggest, what's looming overhead that we all should be very concerned about, has to do with inflation. Have you seen what the Fed has put out recently, the inflation numbers?
Well, it depends which numbers you're actually looking at.
Well, if we're looking at the CPI and the PCE, let's consider those two, because that's the Fed's favorite form of inflation measurements is the PCE. And that's Personal Consumption Expenditure Index.
Mm-hmm.
The other is the CPI, Consumer Price Index. And we've talked about it before. I've talked about it all the time about how those names alone would lend one to believe that they are tracking everything we're spending money on. And then we come to find out, differently. Now, I know, and I'm going to ask questions that you may or may not, you're looking at the housing market, but I'm still going to ask the question, not so much for you to think on, but for a person, somebody else who's watching this to think, okay, I'm going to compare myself to Mark. They're going to get a number in their head and see if you get it right. If they get it right or you get it right, it's going to be one of those things that they can call you up and bust your chops if they beat you on here. So what's the Fed's target inflation rate?
2%.
2%, right on. What is it right now?
Right now, probably 2.5 is so they say.
Actually, this is where it gets exciting. The Fed's CPI, most recent released CPI number, Consumer Price Index, 4.1.
Ridiculous.
So it's
So
double.
only been that high a couple times.
Double that rate of, double the rate of inflation of what they're trying to keep it at, right? So, and think about this, right? The CPI and the PCE are both cooked metrics. They're cooking the books on these metrics and what they're willing to count in, and it's still going high.
Meaning
and the Fed's like, no, we're going to let it run hot for a little while.
Right.
So what I'm going to do is I'm going to share a screen with you guys so you can take a look at some inflation charts. And so we can look at what's really going on out there. If I can there we go. So this is John Williams shadow stats. So these is the chart coming up. It's got a blue line and a red line.
We see them. Yep.
Okay, very cool. So what we're looking at here, and I like to use this one right here. This goes off of the CPI, and then of course what John Williams will show as far as his version of the real inflation. So you can see how both the red and the blue are following each other till you get to about 1982-ish, 1983, somewhere in there. Well, then it starts to go opposite directions. Do you know why that is?
I do not.
So the Fed started utilizing the CPI at that point. And and with the CPI, it's an index, right? So you got the Dow Industrial Index, you got the S&P 500 index, you've got the other one is right there on the tip of my tongue. Let's just those two, right? Dow and S&P, right? Two different indexes, but they're all stock related, right? So even though they have index and stocks, only certain stocks do they follow. That's why you'll see those indexes do certain things. The NYSE, that's the other one. So you got 3 different indexes that encompass stock for at least the different segments or sectors that they look at. So these are 2 different indexes The CPI, they only look at durable goods that they can affect with monetary policy. That's why you start to see that it go a different direction. So the Fed is using only certain things that they're going to track. They ignore a lot of other things. What are they ignoring? Food costs, energy costs, segments of housing. They definitely don't factor in taxes, or all of these would be much higher because taxes keep climbing. So John Williams, he factors those items in. So he shows what people are really spending their money on. What's happening to the cost of those things is going up significantly compared to what the Fed was saying. Now, what's interesting here, you start to see back here in the early 80s, it starts to go down. It's trending downward. They're trying to say that their inflation is getting better and they have better control of it, when in reality, if you look at what John's showing, it's done nothing but go up this entire time. Now, you see things, sometimes it drops. This is right around 2008 when everything, the floor fell out of everything and started to come back. But now you see where we're at now. This was the pandemic, and now you see things really starting to scream up. Well, now with that screaming upward, the Fed's claiming right here 4.1. We're right approaching 5. But where's that put us here? We're 12 plus for real inflation. So why is that a concern? What happens to the dollar's value with inflation?
It reduces its purchasing power.
Reduces its purchasing power. It's not even, a lot of people, when you talk about value or not value, it's not really a value. I mean, it's kind of like buying real estate right now. You can't see that the real estate's worth what people are paying for it, but what is the cost of the real estate? It's what people are willing to pay for it. And people are bidding like crazy. There's a frenzied purchasing going on, and it's pushing up prices. There's a difference between price and value, right? It's pushing up prices because of fear. Mm-hmm. Same thing we got going on with inflation. Inflation's going up for other reasons. And so the dollar's purchasing power, not the value of the dollar, is being influenced negatively. So what does that do for us? The reason I like to bring it up is because our dollar's purchasing power, we'll call it value, since it's diminishing, we get to raise rents, right?
That's correct.
How much are you guys raising rent by each year in Memphis?
So we actually have it in our lease after the first year to raise it 4% to year 2.
Wow, it's in the lease.
It's in a contract.
So let's pause right there. Anybody who's wondering about where do I go invest my capital with, and who do I use for property management? Damn, I don't know of anybody putting that in the lease anywhere. Now, there could be, and I'm just not seeing them. You're the first one to tell me that they're actually putting in this is what's happening next year in the lease. That's awesome. So 4%. I use 3 is what I use for. The national average is about 3.6. So 3 is the number I always kind of look for. So at 4%, let's do some numbers here. You good with some math today?
Sure.
All right. So I'm even gonna get my calculator because I've not run this thing with. We're gonna double check our math on this thing and see how it all works out. So, and those who are watching, get your calculators out. Let's do the math together. So if you're buying $100,000 property and you're gonna put 20% down. In fact, I'm actually gonna get a tool out here, and we're gonna do that. I'm gonna show the tool. Do a share screen with this tool so we can talk it over. I just did some of the changes on it. So let's just say we're going to, and I'm going to change the date to 7/1/2021. We're going to go, and the rates, I'm going to go a little bit high on the interest rate because we have inflation coming. I want to show it on a little bit on the higher side. So we're talking about a 30-year fixed, 4.5% interest rate, $100,000 purchase price, $80,000 loan, putting 20% down. 7% inflation. The only reason I'm going with 7 instead of 12 is because we as investors spend our money differently. We're going to go with a little bit lighter inflation. We don't buy into the things that most people spend their money on. We're not consumers. We're real estate investment business owners. We're going to go with $1,000 a month rent and 4% rental increase. That seem about right? I
like it.
Okay. So what this will not show us is what I kind of want to talk about here is initially is if you're getting rent for $1,000 a month, year 1, and let's say you're getting $200 a month in cash flow year 1, does that sound unreasonable?
Definitely not.
Okay. So year 2, if you got $1,000 a month in year 1 and your contract says 4% year 2, what's your rent going to be every month in year 2?
Great. So in year 2, we get to have a monthly rent of 4% times 1,000. So that's going to be $1,040 per month in rent.
1,040, correct. So that's basically a $40 a month increase, right?
Correct.
So if you're making $200 a month year one, and in year two you raise it by $40, what is your cash flow going to be year two?
So now you're going to take the rent increase of $40 per month divided by what it originally was at $200 a month, and that's about 20%. Massive.
20% compound growth. That's huge. Absolutely huge. If that was the only thing that you got was a 20% compound growth in your cash flow, you just won. I mean, you won huge. That is massive. Now, but here's the thing. So we can see that compound increase year over year over year consecutively. But what we're not seeing also that people fail to realize when you're locking in, regardless of what the interest rate is, when you're locking in for 30 years, the lender doesn't get to raise the payment on that loan because of inflation, right? They're stuck.
Right, you're
if
locked.
they lock it in for 30 years, you're paying that. Well, look what happens over 30 years. So you've got, let's see here, your payment number one, $405 a month, which is $103.35 principal, $300 interest, for an inflation adjusted payment of $3 after a year. $2.35. So the value of that $405.35 by the end of year one is equal to $403 at that point, right? So as you continue to go down, you start re-adding all those payments together. You can see how that diminishes. Look at month 76, $405.35 because of 7% inflation was only worth $260 in actual dollar value, its purchasing power, all the way down to get to 365 or 360 months in. And you start to see how that starts to decline. See 360.
Wow.
That's where 49.94 is the value.
Tomorrow's dollars. Yep.
In tomorrow's dollars, right? So the cumulative value of all that, here's your principal and interest over 30 years, 145, 925, 37. But when you add those all together and you factor in how inflation has eroded the dollar's value over 360 months, it's equivalent to 60,926. That's how much your lender's really making on lending you that 80,000. They're losing nearly $20,000 to lend that to you for 30 years while you're raising your rents by 20% per year in cash flow. Who's winning?
Wild. We are. Wow.
And what's the property value doing in an inflationary environment like that?
Oh, inflationary environments, rents will go up and values will go up as well.
Exactly. So when you're talking about this, some meme I saw somewhere on Instagram or whatever, people talked about inflation. This is how the rich get richer and the poor get poor, because the poor is hanging on to their cash, right? They're putting it in a shoebox and they're hiding it under their bed. Well, that shoebox is worth less and less and less every year the longer it sits there. It's also doing the same damn thing in the bank. It's losing value in the bank. What's the bank paying you on your checking account?
Probably negative 10 basis points max.
And even on my money market, right? I've got a bunch of money tied up in my money market account. I'm making 2%, not even 2%. I think it's under 1%, just over 1% of my money market. That's a joke. So when you think about that, they are making huge capital on those funds. They're putting that to work out in the market. They're hardly paying you anything. It's actually flipping around now that there are some banks, as I understand, I haven't seen it personally, they're going to start charging you for all your accounts. You're going to be paying them to run the account. Oh, wow. So you're at a negative just by, you're basically paying for a service now, because it's getting to a point that it's a cashless society. They can charge you for that service. It's no different than when you're running your credit card. If you're not using a credit card with perks, you're losing money because the credit card itself is charging you a lot in interest. And if you're not paying it off regularly, you're losing money. Secondly, you got a lot of retailers are going to charge you for that service. Now, if you don't have one that has a lot of perks and you're putting it to use properly, you're losing money. Now, the other thing is I don't use my debit card for a damn thing. I don't put myself at that kind of a risk. I use the credit card, but it's got to be the right credit cards, right? So, I know we're diverging off of the main topic here, but ultimately a person has to be smart with their capital. The system is built to take from you if you play the way the system says to play. If you go against what the system says and you listen to these other things out there, these outliers where, there's a small percentage of the home buying population that's doing investments. The majority of them, in fact, with recent stuff that went down with Fannie Mae and Freddie Mac from the U.S. Treasury, they're trying to make it to where Fannie Mae and Freddie can only do 7% of their loans towards investors and to second homes. They're pushing the entire home buying population, 93% of that to be funded by Fannie and Freddie. What does that tell you? If they're trying to do that, they're trying to force the angle that people don't get wealthy. You want to keep them in servitude. You got to keep them monetarily insolvent. And if you keep them in cash, that's what you do. You go into real estate, it continues to grow in value. You can borrow against it. You can pull your capital back out. You can put it back to work. I'm not seeing anything that would lead me away from real estate.
Well, definitely not in an inflationary environment. Exactly what you were saying about before. That's the best place to go in an inflationary environment, which
even in a deflationary environment.
Yeah.
Even in a deflationary environment, you buy the asset while it's getting cheap because eventually it goes back up.
Mm-hmm. And you lock in your rates while you're at it. And then if rates go down, you refinance. If rates go up, you're winning.
And if rates go down, you only refinance to pull cash back out. Don't just refining for rate to me is asinine. Don't do that. But let's do another little quick exercise about that. So have you ever noticed, and you're a younger dude, you ain't been doing this as long as I have, there's a lot less gray in your beard than in mine. Yep. So I don't know if you've noticed how often refinance booms come about, that you start seeing the commercials for now's a good time to refi. So I've been doing this for coming up on 24 years by the end of this year. I see that every 4 to 5 years. So if you're seeing that every 4 to 5 years, what does the first 5 years of an amortization table look like on your loan? Is it pretty heavy interest, or is it?
First 5 years are going to be extremely heavy interest and minimal principal.
Hardly any principal reduction in those first 5 years. But if you can get the people to refinance just for rate every 4 to 5 years, what's the balance of their loan doing?
It just basically doesn't get paid off. The principal is not getting paid off.
The principal typically goes up because they convince them to add the cost back into the loan, sometimes pay a point to get a lower interest rate, right?
Mm-hmm.
It makes your monthly living better, right? But what happens is they increase their liability, but then they're paying an interest heavy period again for 5 years. So if you are a banking entity, or the banking nation, if you will, however you want to reference them, you call it the cartel, the banking cartel, whatever you want to call it. If you can convince people to keep doing that for the entire 30 years, right? Every 5 years. Can you imagine what that looks like 25 years in? They have a higher balance than where they started with. They're paying just the interest for the first 5 years, and they keep doing that. They've never paid it down. Who wins in that environment?
They do in that environment.
They win huge. And that's why they offer a 30-year fix to you, because such a small percentage of the population will actually do what I'm talking about, which is pay it the way that they designed it, because then they lose money.
Well, then what's the return if someone follows your advice?
The return for the bank, it's a massive loss.
Right.
The banking world loses somewhere in the range. They will not. Well, let's just run the numbers right now. So I'm going to go ahead and share this screen. Let's figure this out. So if you borrowed 80,000 and you paid them back 60,926.91, you divide that into 80,000, you paid them just over 76% of the balance. 76% of the balance is what you paid them. How insane is that? I'm going to go ahead and I'm going to share screen here so you can check my calculations as to where I came up with them. Right, so you can see the chart now that I started with the inflation.
We got it.
So 140. So it was a principal of 80,000, interest of 65,925, 37 over 30 years, for a total paid on 145,925. That's where people say, I want to pay this off faster because I'm paying so much in interest. But because you're paying it back with an instrument that's losing value, hold on to that money, use it to build your wealth, and give it back to them very slowly. You're only giving them 60,926.91. You can see how,
right, as opposed to the 145.
As opposed to the 145,
right.
But you borrowed 80. So that's where we go back to this, and we show that you were only paying them just over 76% of the actual balance of 80,000. 60,926 is 76.15% of 80,000. You never paid them interest. What you did is you paid them a servicing fee, basically, but it wasn't much of a servicing fee because they lost that money. Mm-hmm. So if they can convince you to keep refinancing it because rates are better now over the next, every 5 years, over the next 30 years. So that gives me a little bit of encouragement to where are rates going to go, right? Are they going to go up or are they going to go down? Why do you think the Fed has dumped trillions of dollars into mortgage-backed securities? So let's go back to 2000. Let me see if I can find this chart. I have to go into log into something. If we go back to 2020, when COVID had hit, you know, what date did that actually hit us?
Oh, mid-March.
It was March 9th is when it hit of last year. And I remember that because I was sitting in the airport. I'm like, why in the hell are my rates so crappy? I don't get it. What happened? And nobody could explain it to me. What had happened? Why did this cause all this grief in the market? I didn't understand why the interest rates did what they did. And then I started to asking a lot of questions, figure out what had happened and what really had occurred. And we're going to go into this right now. See if I can share this one. Where's my share screen capability? Here we go. So what we have here is you can see where the interest, this tracks the trades of the interest rates on a day-to-day basis. This is the mortgage-backed security. This is the universal mortgage-backed security. This one is the ones used for owner-occupied homes. So if you see, you know, this is way back in 2018. That was when we were actually kind of at a higher spot in the rates. This is probably high fives. And if you remember that was when we were back seeing those higher fives at the end of 2018, early 2019. Then we started to see that mortgage-backed securities was getting a lot of traction, a lot of people investing in there, bringing the rates down. So it's a supply and demand of money. The more money goes in, that means people have more to borrow from, and therefore they have to bring the rate down because it's a huge supply, lower demand. Then we get here, March 9th, like I was saying, 2020. That day is when the stock market took its biggest beating in 2020, if you remember. So when you put your money in your bank account, we talked about the banks earlier. Do they put the money into a vault for it to grow, or do they put it out to work somewhere?
They leverage it to the hills and put it out.
Leverage it to the hill, right? And so not only do they leverage it because they can lend it out at 10-to-1 ratio, but then they put it into the stock market. And they don't just put it in the stock market, they go in on margin. So when the stock market bottoms out, what happens to them when people are on margin?
Well, they get called.
Get margin calls. Ugly, ugly, ugly. That's why I never go on margin. I remember early in my career, this one guy in my office, I got to pay a $20,000 margin call. I'm like, what the hell are you doing? Right? It makes no sense. If you watch The Big Short, you know, they were paying massive margin calls on that, but it paid off in the long run. So March 9th, right? Stock market starts to crash, keeps crashing. Actually, it was crashing before that. Their margin calls came in on the night, and that's what happened was those banks started selling, and all these other people had their money out there, started selling all their assets to be able to pay those margin calls. The assets, because they didn't have the money in the vaults, right? So their assets were mortgage-backed securities and they were treasuries. They were selling off their bonds. So you can see here, we started having this big decline. That's where it bottomed out, and March 20th was its bottom. So you can see that was, take that all the way back to May 29th of 19. So over nearly a year's worth of gain got dropped overnight because they had to sell off all these securities. Well, it was March 20th when the Federal Reserve started buying into the mortgage-backed securities. They put in $1 trillion from March 20th up until March 30th, right in here. $1 trillion was invested just to bring it back up to on the trajectory is already heading. And then they maintained this sideways movement. It wasn't exactly sideways, but close. And to the tune of $4 to $12 billion a day. And that's what they published. We don't know for certain how much. So you can see how many trillions of dollars have gone in from March 20th all the way up until right around March. It was actually March, I think it was March 11th of this year that they kept pouring that money in. So literally a year later, they decided they were going to change it. The U.S. Treasury now, look at how many mortgage-backed securities they owned at that point. They owned the bulk of the market. The U.S. Treasury did through the Fed. The U.S. Treasury printed public money to buy this and flood the market. So then they come back to Fannie and Freddie and say, we are going to now require that 93% of all the loans you do and back go to owner-occupied housing, not to investors, because right? There's this little bit of a rob from the rich and pay to the poor type thing going on right now. A little bit of a Robin Hood type of action on the part of the administration that we've got. They're taxing us. Now they're taking opportunity in the form of financing away. So because of that, Now we can see where they're heading with what their plan is. So I think, and this is circling back around why I even brought all this up, I think the reason why we're going to see interest rates probably stay artificially low, because they are artificially low at this point, because the federal government wants to continue to buy these votes by giving people opportunity for housing. Take from the rich people, give everybody else a house, right? Here's the thing that's not factoring in correctly for them at this point. There's no inventory.
Mm-hmm.
And even with the inventory that is out there, the prices are going so damn high, it's pricing all those people out of the market anyway. So all we're doing is creating more renters, no matter how they go about it. Now, we can't go to this particular bond pool to get our money for investors anymore because they're limited. So we have to go to what they call Wall Street aggregators, which is other pools that are being created to fund this. Some people freak out. We're going to continue to get that. Well, we've been getting jumbo loans done for eons, right? Fannie and Freddie don't fund the jumbo loans. In fact, when I got into the industry, a jumbo loan was anything over 275,000.
Wow.
Now jumbo's what, 500 and some $1,000 across the country?
Market specific, even higher. Yeah.
Exactly. Yeah. Certain markets are over 700,000, right? So when you consider that, we have a market that's been able to fund jumbos all along. We're going to continue to fund real estate investment. So what I tell everybody is, now that you're armed with this knowledge, don't waste your time or your energy or all that effort trying to find who's the cheapest. You'll always find the cheapest, but can they get the deal done? Do they understand it? Have they targeted it? You know, you can talk to any lender out there. Majority of them will do loans for anybody. Don't care if it's a refi on a primary residence, a first-time home buyer deal. It could be a bond loan. It could be a FHA or a VA or a USDA. They don't care. They'll be everything to everyone. I've found that if you become everything to everyone, you become nothing to no one. So I focus on investors. Now that you know this, it doesn't matter what the rate is, because inflation is going so damn high, we'll never catch them in rate. The only way to curb inflation is to increase the interest rates, but they're not willing to do that right now. Take advantage of what we have now. It doesn't matter what it is. If it's below the rate of inflation at 12%, you're getting a deal. You're making money on the money. Right now, it's probably in the low fours. You're making 4 times your money, or 3 times your money right now on that money just by borrowing it.
Mm-hmm.
Just by borrowing it and paying it back slowly, you're making 3 times on your money, not even using it. Then you put it to use in real estate, and you're making hundreds of % return. Is there anything that I failed to touch on you think would be really important?
Man, I mean, just in summary, it sounds like now is the time to get involved, wouldn't you say?
Well, I'd say every time is a time. Look at the deal, right? Set your baselines. In this situation, we talked about 100,000 making $200 a year, a month in cash flow. Very reasonable. And look what happens with that 4% increase in rents. The other thing that I really want to caution people on is, don't get so damn caught up in what the pro forma says about year one. It doesn't matter about year one. What matters are, do you have a solid property that will stay reasonably rented for the time that you own it? Do you have a solid team that will keep it rented? And can you raise rents? If you can get all that, then it doesn't matter. Get into the deal, because if it takes 3 years to make a solid cash flow, then it doesn't matter, because it's going to continue to compound from there. Don't get so caught up in cash flow year one. I see that way too often, and people walk away from a phenomenal deal that you can get a 20% growth on your cash flow. Are you freaking nuts? Take advantage of the opportunity and do it now.
Right. And exactly what you said is
closing.
Right. 100%. And exactly what you said, the real value is by holding on to it down the road. So if you're looking within this short period of time, within just a couple of years, well, you're actually not really understanding the true value of the investment. The true value is just holding on to it and paying off the loan as much as possible, unless you get to the point where you can do a cash out refi to go buy more properties. That's where the real money is made. Because if you just hold on to the property and pay off the mortgage, or have the tenant pay down your mortgage, in 30 years, you're going to own that property in full. And if you look at the math on that, it's about a 13% return on investment just by having a tenant pay down your mortgage over 30 years. So that's roughly a 13% average annual ROI just by having a tenant in place, which to me, that's one of the most wild and exciting things about being a real estate investor, because that's a floor. That's just the floor, and it can only get better.
That's the start point.
Yeah, exactly.
13.33% growth is your start point if you never put another dollar in the deal, and if you never even made another dollar.
Rents
if
don't
all
go
your
up.
tenant did was pay it down and pay for the maintenance and the taxes and the insurance and all that stuff, then you still made a bottom line of 13.33%. You know, and so hundreds of percent is potential. continue to expand it and grow it. And don't get so caught up in being a consumer. Consumers think about, is there a coupon in the mail today? And can I go find this particular thing in bulk and cheaper over at Costco versus the grocery store? It doesn't matter. Get good people. I would much rather shop at, the local grocery store down the street than brave the crowds and the problems of Costco, because I make more money being here on the phone, talking to clients, building my business. And if I can run straight down the street and be back in a matter of minutes versus hours, I made more money than saving that 50 cents on that product. Who gives a crap? That's not what this is about. It's not about saving 50 cents. It's about building a legacy and a business and wealth. And that's all that's all we're focused on. If you're not focused on that, then go to the internet companies and don't come to us.
Right. 100%. So if someone does want to build their business and they want to get more information, reach out to you. How do they take the next steps?
Well, I'm going to show you that. I'm going to actually put this in video so people know. So we're going to go to aaronchapman.com. And you look for the redneck on the porch and you're in the right spot. So one thing I'm going to plug also, a couple of things here. You've got loan process tab that will lead you to some videos where I go over the entire process. Videos shot from my office in Missouri, so you can see the entire process that we go through for your loan. There is the media section where I've got a bunch of videos where I go over the market every week, twice a week. Well, you'd think twice a week, but I keep forgetting. I didn't put the other one out there.
You do a great job.
See all these where I go over the market, what's going on there. And then another thing I really want to plug on to plug for folks to take a look at, just scroll down on the main page. For every transaction that we close, we donate $50 to this particular group. Now, what shows here, when you click on that, you have the opportunity to donate. I ask investors to throw in $50 for every time you close on a deal and go in here and keep building this up. Now, I've had a handful of probably 20 or 30, I don't know how many, probably 70 investors now. We've raised $22,739 just through investors and people donating. Now, we have also had, this is all the donations that came in. This does not include the $50 per transaction we've been doing since last September. And so that's probably some of the range of close to just probably a little over 50,000 that we as Security National through my branch have donated. And on top of that, I presented this in front of a room of business entrepreneurs, and we raised 119,000 in 10 minutes. And the founder of this particular organization is named Tim Ballard. That's a shot of him right there. He was there to speak at that event. I introduced him, I brought him in. And so right now I have a goal of $250,000 a year that I want to get donated there. We've achieved that goal since September. So I want to continue that goal of $250,000 a year to go to this organization, because if you don't know about them, you need to go find the Amazon. It's on Amazon. So here's a movie called Operation Toussaint. So go check that one out. It is did this pop up on the Amazon Prime thing pop up there? Okay.
You're good to go.
Out. It is an amazing video about what this guy went through to create this organization. And they basically take down human traffickers across the globe. Thousands of people they pulled out of it, and they haven't even dented it. It's amazing what's going on out there in the world.
Wow. Well, that's an incredible amount of capital that you're able to raise for a better purpose. I love it. So anything else you want to talk about?
Well, I mean, for me, that covers everything, right? We've got the process, we got the business, we got your what you need to be thinking, we got the mindset, then we have the cause. Mm-hmm. And I'm pointing to my screen over here. That's why I got the point, because I got 3 screens up. So I look at myself, and this was coined by a good friend of mine named Eddie Wilson. He says, I'm a cause capitalist, and that's me. We're cause capitalists. We don't do this for ourselves. We do this for the sake of other people. And then I had to find something bigger than just the sake of business, because one of the reasons I push as hard as I do is for people like yourself. I need you, when you drop my name to a client and say, hey, I want you to talk to Aaron Chapman, I need that person to already know who I am. So then I'm like, whoa, wait a minute. Mark mentioned that one guy. I've heard of that guy. That must mean Mark's a badass, because if I'm hearing this guy and Mark knows him, then that's going to solidify the relationship with you. But it can't be just about that. It's got to be about something else. And now it's for this cause. And now I have more fuel to push harder and build bigger. Because like I said, I have a goal of 104 employees. Why do I need 104 employees? Because I have a goal of 5,000 transactions. Why do I have a goal of 5,000 transactions? Because I want to fund the hell out of this operation. That's why. is not for me. I don't need the money. I don't need the wealth. I don't need the notoriety. I don't need fame. I need my conscience to be clear that I'm doing everything I can to help this operation.
Man, I love it. So if you guys out there, if any of that resonated with you, if you want to be part of a higher cause, please reach out to Aaron. We can pass along his contact information as well. That's all we have for this session, and on to the next. Appreciate you guys.
Thank you.
Hey, everybody. Mark Hart here from Memphis Investment Properties, and I am pleased to introduce this interview that we're going to have with one of our top current clients, Zack Taylor. Zack, welcome. How you doing today?
Good. How you doing, Mark?
Hey, I'm excellent. Wish I was golfing with you. That's for sure.
I wish I was golfing today too, but not today.
Exactly. So, Zack, let's just dive right into it. So why don't you just tell us a little bit more about yourself, your background, your career?
Sure. So I'm 46 years old. I- I'm, I'm married. I've got two daughters, ages 10 and 12. Been married for about 16 years. I'm in construction sales. My wife's a pharmaceutical rep, so she's in sales as well. Just a little history. I graduated UC Santa Barbara in 1998 and moved to San Francisco after that. Lived there for about 4 or 5 years. That's where I met my wife. And once we got engaged, we decided we needed to leave the city. Otherwise, we'd never own anything there.
Right.
So now we've been in Sacramento since 2003, 2004.
Wow. So then how long have you been a real estate investor?
We moved to Sacramento to buy a house. So we bought a house around 2003, 2004. So we bought our first property then. Bought our second property about 3 years ago. Really wasn't planning on being a real estate investor or owning rental property. But that's how we kind of fell into it. When we bought our second home, I was in a position where I didn't have to sell my first home. So even though that was my plan, but my wife actually convinced me that we should maybe hold on to that home and rent it out. And I agreed to it. That was about 3.5 years ago that we rented out the first home that we bought. And again, we own, at that point, we own 2 homes in Sacramento, our primary and 1 rent.
Yeah. And that's one of the best ways to actually, get your very first rental property, right? Is because you can get a significantly better loan when you actually live in the property there. And then we see a lot of people moving out and then just holding on to it and turning it as a rental. Just kind of fell into your lap, sounds like.
It did. I told my wife as long as the rent would cover the costs and I wasn't, at the rental on a Sunday afternoon doing some repair when I should be watching the 49er game.
Right.
I agreed to it, and we happened to get the rent that we needed. I was a little surprised, and rent here in California is pretty high, and the tenants that we got, they happen to be friends of ours now, so they're great tenants. We've never had an issue. So it was after about 6 months of renting out that home that I was kind of like, this rental real estate investing is not such a bad idea. And how could I buy more?
There you go. So then how many properties are you up to now?
We own 12 rentals.
Incredible.
Total.
Incredible.
Yeah. We bought, 2019, I bought 3. I bought 7 in 2020. And 1 so far this year, and plan on buying about 6 more this year if I can.
Yeah, we try to get you on this week, but they're going
I know.
fast. We're trying, that's for sure.
You're going like,
Exactly. I love it. So I guess what in terms of the actual, real estate and the properties that you like to move forward with, how do you decide between, one property and another, whether that's a, 3-bedroom, 1-bath C-class home or a 3-bedroom, 2-bath A-class, or meeting in the middle with a B? I guess what's your thought process on that?
from the beginning, and I kind of, in talking with you, I kind of came to this criteria, but everything I bought's been 3-bedroom, 2-bath, mainly in the B range, own a couple of A properties. I haven't really bought anything that I think is considered a C property, that I recall. A few different areas of Memphis that I like, that I lean toward. So that's pretty much it, that criteria. But as you know, I mean, I think the last few that I've bought, I've just kind of leaned on your opinion as well. I mean, I think the last 2 I bought, I think I was on the golf course when I bought them.
Yeah,
And
that's my favorite.
I think I had about 5 minutes to really talk about it. So at this point, you kind of know what I want, and so I lean on your opinion, and it's
Yeah.
worked out.
Yeah, sounds like you've played a good round of golf every time you've pulled the trigger on the course.
Yeah.
No, that's good. That's good to hear, because with Zach, what we talked about in the beginning, was he didn't need his cash flow and his passive income today, right? He was trying to build that financial independence, for the future. And the goal was to buy less properties in better neighborhoods. Hence, we were able to get him those B plus, A type properties that have a little bit better chance for appreciation, right? As well as cash flow, because then in just a couple of years, Zach will be able to double the size of his portfolio if he wants, by doing a cash out refinance, right? Or, doing 1031 exchanges, right? He's got a lot of options, which is good. So then in terms of the market, I guess, what do you like about Memphis?
My wife and I went out there, I think when we met you the first time, when we bought our first property, hung out in Memphis for a few days. So I like the town. I like the area. It seems like it's kind of an up and coming city. It kind of reminds. I'm thinking it might be like the next Austin, Texas, or the next Denver, Colorado, or even Nashville, Tennessee. I think there's a lot of upside there. I like the economics of the town. Very blue collar town. I know that, what is it, 40 to 50% of the population in Tennessee are renters.
Mm-hmm.
So never had a problem with vacancy. FedEx is there. Amazon's got a big presence there. St. Jude's Hospital's got a big presence there. What is it? Second largest cargo airport in the world is there.
You got it right.
Big time distribution going through there. I mean, so I see a lot of economic future for Memphis, as well as a younger white collar workforce as well coming up. Younger people looking to rent homes. I don't think we've ever had a problem with the vacancy in the 2.5 years, and in all the properties that I have, I don't think I've ever had a vacancy. I know I had one, and I think we had it leased out in 3 or 4 days after that. So just really solid. And for me, I was really looking for the passive income side of it. But what properties in Memphis went up like 12% last year?
Exactly 12%. You got it.
So that's just kind of icing on the cake for me at this point. So yeah, I'm in at this point.
Yeah, no, that was very thorough. You could do my job. That was you hit the nail on the head. Yeah, you hit the nail on the head right there. I mean, our rents went up 5% last year, and appreciation 12%. But here the goal is cash flow number one, right? You got to always make sure you're positive cash flow, positive expenses, but then all the appreciation is just a cherry on top. But now that that's actually happening and consistently happening, that's why we talk about it more and more. It's because the cherry is there, and that's what that'll really help you scale in the long run. So then, final question here is, just how has your overall experience been with Memphis Investment Properties and Reedy & Company?
It's been great. I mean, everything that I was told, in our initial conversations has pretty much come true. I mean, there's been very little deviation from the plan. I mean, when I bought my first home there, I was kind of putting myself out there. I mean, when I came in and told my wife, "Hey, we're going to buy a property in Tennessee," she was like, "You're out of your flipping mind. I mean, what are you
Right,
doing?"
right.
And I was like, "Well, so I'm just glad it worked out, or I would never hear the end of it."
Right. Yeah, she would have been really mad at you. Yeah, exactly.
So,
Good.
the first one, it went well, and I think we bought the second one maybe 6 months after the first.
Mm-hmm.
And then at that point, I just kind of had proof of concept, like this is going to work. Let's keep moving forward. And the properties are affordable in Tennessee. To start buying rental property here in California, it's almost not possible, at least for somebody in my financial position.
Right.
The market's so overpriced. So Tennessee has worked out really well.
Yeah. Well, I mean, hey, that means the absolute world. And we definitely recommend everything you just did in terms of just try with one property, and just let us prove ourselves to you essentially, and to see if, we're a good fit for each other. And that's exactly what you did over about 6 months, and then from there, if it's something that, you want to continue to doing, you can slowly scale. And now it's at the point to where you just call me at the golf course and say, "Mark, pick, a favorite one." And that's exactly, it doesn't get much better than that.
That's true. The whole process has been very, A to Z covered. Not a whole lot of work on, it's very turnkey. Not a whole lot of work on my end. Just, a lot of trust and confidence in Memphis Invest in MIP, and I've been completely happy at this point.
Hey, well, that means the world. So that's it for the questions. Is there anything else you kind of want to share? Any advice, any tips?
Not off the top of my head.
Hey, no worries. Well, appreciate you so much. I mean, it's been a pleasure knowing you for the last couple of years, and now I just need to meet up and go golfing together. That's the next
That
step.
sounds good, Mark.
All right. Well,
I
thank you
appreciate
so
it.
much, Zach. Really appreciate you, and have a great day.
All right. You too, Mark. Take care.
All right.
Well, guys, you might be seeing this Yeti hanging out right here. And so what we're doing is we're going to give away a few Yetis to some lucky individuals.
3 lucky individuals. And there's 3 different ways to win the Yeti. The first one is, you've already done it, is just register and attend the actual event. Then the second way to win the Yeti is to subscribe to our YouTube channel. And the third way to win a Yeti is to be interactive and have the best comment in the little chat bar.
Yep, so be commenting. Let us know your thoughts, comment, or question. We will consider on helping you win that Yeti. So thank you so much, guys, and we appreciate you being here.
All right, welcome everybody. Mark Hart here. I'm very excited to introduce our next speaker for the 2021 SOFA Summit. I love this topic because most of our investors always ask, how can I find more capital to buy more rental properties and grow my real estate portfolio? And what Ramez at the IRA Club is going to teach you how to do is an extremely simplified way to utilize your retirement accounts and the capital that's already within those accounts, 401ks, IRAs, etc. But it will give you the power and the ability to actually buy long-term single-family rental properties within the account. And Ramez and his company makes this process extremely simple and extremely painless. And it's something that we've been partnering together for multiple years now. So without further ado, Ramez at the IRA Club.
Mark, thank you for the kind words. Honestly, one of the reasons why I love Memphis is you guys practice what we preach is education, education, education. It's one of the biggest reasons why I love working with you, hence the SOFA Summit. I actually want to, again, thank Mark and the Memphis Investment Property team. You guys, speaking about making the process simple, you guys, kudos to you. You guys really do a great job of walking and also helping your investors through this whole process with us. So without further ado, we're here to talk a little bit about self-directed IRAs. Give me 1 second to share my screen. And Mark, if you just please confirm with me as I blow up the screen. Is that
all
good to go?
Oh, it is perfect.
Great, thank you. So again, Ramez Fakoury, Vice President of IRA Club. I've worked for the company for 5 years. I am also, believe it or not, Mark, I think you know this about me. I'm a restaurateur for over 22 years. I got involved with the IRA Club because of my wife, who happens to be also the trust officer. Started the company here with Dennis. Actually, back in 2008, she's been here for 10 years. Dennis has obviously been here the longest at 13 years. And again, we are a self-directed IRA company based out of Chicago, Illinois. And we just want to go over this disclaimer real quick, which is IRA Club does not offer or provide tax, legal, or investment advice or endorse any product, services, or the investments. All information and purposes are for educational purposes only, hence why we are here to talk about self-direction, which is control. And we encourage all parties to consult their attorneys, CPAs, and financial advisors before they move into any type of investment. So again, we are here to talk about the IRA, the individual retirement account. Give me one. I'm sorry, Marcus, moving the screen. The IRA it was first established by Congress back in September 2nd, 1974. And actually what most people don't know, and the reason why it was created was really and essentially in the beginning was regarding pensions, and pensions were getting less and less readily available by companies. We obviously know where we stand with them right now, present day. And it really, the underlining aspect of it was we didn't realize that it was going to also address other topics and issues that we're facing into retirement, which, well, the fact that Medicare, Medicaid, and Social Security, which are government programs, are extremely broken and suffering. We know where we stand with Social Security. People are living a lot longer. They're going to have to address it at some point. But this was the reason why IRAs were first created. But we need to face reality as not only Americans, but investors, and especially for savvy investors. And we're here, listening here at SOFA Summit, because we cannot overlook this. Okay. If you take a look at these breathtaking numbers, in 2021, the government has bailed us out close to $9 trillion. That is a staggering number. And the reason why, again, I bring that up is because Biden and his team, including the Treasury Department, have made it very clear they have to raise taxes because they have no choice. And that's where the inflation is going to kick in. And I'll talk about inflation a little bit later, but truth be told, it's already here. We all know that. We've already seen the articles by CNBC, the Washington Post. But with this, knowing that taxes are on the rise, that Biden has made it very clear. A question we get given quite often is, how do we get rid of Uncle Sam and grow your investments potentially 25 to 50% faster? And, obviously that all depends on the type of IRA account that you are choosing. It depends on the amount. It depends on the longevity of the investment. All those things take into factor. But again, you could really grow your not only your retirement, but your earnings later on in life 25 to 50% faster when you utilize this gift. And I actually call it a gift because there's not that many investment vehicles that you could use tax deferred or tax free, hence the traditional and the Roth. Now, there are other types of IRAs, but these are the two most common. And just to be clear, they are all governed by the same set of rules and regulations when it comes to the investing. The only differences are with it's just when you pay the taxes. You know, with the traditional IRA, it is tax deferred. So essentially, you're taking the deduction, and then you will go ahead and use that deduction to invest. Versus the Roth, you're paying the taxes up front. Hence, you are watering the seed to get to the fruit of the tree, meaning all of the gains moving forward are tax-free. Hence, here at the IRA Club, we have always been partial to the Roth. We always encourage the Roth. It is one of the best ways to grow and get rid of Uncle Sam. So again, and also full disclosure, self-direction is just a marketing term we use in our industry. When you think of self-direction, truth be told, all retirement accounts are self-directed. You chose where to have your retirement account, whether it's a 401k, a 403b, a 457, an IRA, a TSP, on and on. You choose to open up your retirement account where you want. It's the control aspect of it, which brings me to the benefits of self-directed IRAs. Number one, diversification, okay? With diversification comes control. So that's one of the best reasons why to self-direct. It's investing outside of the norm, outside of the classical brokerage firms like the Fidelities, Vanguards, and Schwabs of the world. The only difference between the classical brokerage firm and the IRA Club is what you can invest in. We give you the availability to invest in what you know and understand best. And I'm assuming the reason why we're all here is to talk about real estate and think about investing in real estate. And that's probably the only piece of advice I would ever give to anyone looking to self-direct is invest in what you know and understand best. And real estate's one of the best ways to go. I actually do it myself with my self-directed IRA account. But again, the icing on the cake is growing that investment 25 to 50% faster by maximizing it with self-direction with the tax savings. Now, the problem that we always face within our industry is 3% of Americans only self-direct their retirement funds. Why is that? And it's just really simple. It's just people don't know. People never grew up with self-direction, educating themselves about self-direction. It's not something we've ever learned in college, unless you were taking an economics course. They barely brushed up on it. And it's not something really, when you sit down at the dinner table, it's not something like your father or you or your mother or just, you never really talk about, oh, let me go ahead and open up a self-directed IRA account and invest. Because, and again, I want to be truthfully honest, is it's boring. Investing inside an IRA can be very boring because it's the slow and steady race. That's the goal. And you need to understand that. So, but there's something great and sexy about growing that retirement account and getting rid of Uncle Sam. And I'm going to give you an example of that later. Again, 97% of Americans only hold their retirement accounts in 3 places. You're talking about just under $34 trillion. Those are banks, insurance companies, and obviously the market. Now, with banks, they were the first to capitalize on it when the IRA account was first established by Congress in 1974, and that was a CD. Now, truth be told, this is the worst time to ever look at a CD, or ever, in my personal opinion, but to each their own. Goldman Sachs is actually giving the best offer right now at 0.5 percentage point. So please do not even consider that. That's just, again, my own personal opinion. Next were insurance companies, and their product were annuities. Now, this is just something that you could Google on your own. I'm not going to get into the actual breakdown of annuities, but in particular, the ones that you want to look at, especially if you're between the ages of 45 and 65 and you're considering retirement or moving your old 401k account or your 403b or any of these qualified retirement accounts into annuity, is called the fixed income annuity. Basically, you are tied into a rate of, again, Google it, between 4 and 5%. The question that I always ask an investor is, do you think that you could do better than 4 or 5%? And I ultimately leave that question up to you. But The one I do really want to concentrate on is the stock market. And when you think of retirement accounts, the majority of people leave their funds within the Fidelities, Vanguards, and Schwabs of the world. I actually call them the four horsemen in our industry. They actually control just under 70% of all retirement accounts, which is a staggering number. Fidelity being the head of the pack at just a little over 30%. But what I want to look at is the average rate of return within a mutual fund. Now, we all know that mutual funds are broken up into 7 categories: large, mid, small, international stocks, and bonds. Now, when I grab my mouse, and you could just follow along, I don't want you to look at 2020. You know, when you see that just under 10% at 9.5%, I just want people to understand that number is very skewed. And the reason why I bring that up to you is I just mentioned the government bailed us out at $9 trillion. If you actually look at the numbers very closely, because of the pandemic, we had our first quarter in 2020 was the worst in the stock market's history at 24.7%. So truth be told, again, the government had no choice. Otherwise, we were looking at an economic meltdown. So 2020, again, is a very skewed number. I don't want people to really look at that particular year. But what I want them to do is look at the last 15 years. You're talking about 6, 8, 7, and again, just under 6%. You're talking about an average of 7% within the market. Why am I bringing all of this up to you? If you know that taxes are on the rise, if you know that there is going to be some sort of correction again in the market, what I want you to understand are people between the ages of 45 and 65, again, that are looking to potentially retire sooner than later. Obviously, we all aspire to get there sooner than later. You can't afford to get hit with this inflation that we know is already here at 5%. Every single Bloomberg, CNBC, the Washington Post, every economist is actually thinking that the 5% is actually on the lower end. Most people really do believe you're looking at somewhere between 6, 7, 8, 9. Who knows? Who really knows what that number is going to be? But they do know 5%. And the reason why I bring that up to you is when you look at inflation within the market, it works against you, and you can't afford to take 2 or 3 or 4 years or potentially the next decade with inflation working against you. All right. So what's the best way to counter inflation? Real estate. You have to stay ahead of inflation. You can't have the mindset anymore of set it and forget it like we had in the last 10 plus years in the bull market run. That is no longer the route to go. The herding method, you know, of what this, if everybody's doing this, this must be the right thing to do. You have to look for alternative investments. That is the best way to, again, ride the inflation wave by adding real estate to your portfolio. Again, the other thing that I do want to bring up again is, you know, history always just has a way of repeating itself. We know this. It has a rhythm, okay? And the market typically has the same pattern we see of between 8 to 12 years. I'm not going to go all the way back. We're just going to take a look at the last 2. We all know about the 2000 dot-com bubble, where people lost a third of their retirement accounts. If you were heavily invested in the tech market, you lost about 80%, which is a scary number if you think about it. We all know the Great Depression. Most of us were here for it, okay? The 2008 housing crash, okay, which ultimately worked out great for the Memphis team and a lot of other people, including myself. But if you think about it, you cannot, again, if you're between the ages of 45 to 55 to potentially thinking about retiring at 60, 65, you cannot wait for that correction. So that's where I feel like during this pandemic, and there has to be, again, some sort of correction. We just don't know what that number is. But the reason why I have this graph below is the one thing that people need to understand is real estate, the rental real estate in particular, has never, ever faltered in the last 20 years. It has steadily gone up every single year. And I want people to understand the reason why. You have to think of double-digit returns. You cannot rely on this 7% for the next 10, 15 years. Or otherwise, you're just going to be working forever, truth be told. So the other thing that the pandemic caused is the perfect source of untapped capital. It's all sitting within your retirement account. In fact, over 60% of Americans have access to this. We all know because of the pandemic, just around 50 million people were either furloughed or lost their job. So they had the availability to take their 401k or 403b or 457, or if you're in the military or TSP, and you had the availability to roll those funds over to an IRA. And that's, truth be told, that's what a lot of Americans did. In 2019, there was just over 9 trillion. In just a year and a half, that number jumped to 14 trillion. An extra $5 trillion went into retirement accounts. But here's the problem that I'm seeing. Out of those 64 million IRA accounts, just under 1.8 million have $1 million or more. So the question that I always ask investors or people that have retirement accounts, what are you doing wrong that these people are doing right? Truth be told, they're self-directing their funds. That's the only difference, is they're taking control of their retirement account and creating these double-digit returns. And that's something that you have to do. You have to do. So let me give you an example of what I mean. A Roth IRA account. So if I told you already have these funds available, even a traditional IRA account, you could play with the numbers. You could do a Roth conversion in the future. But we're doing this with a Roth because we always favor the Roth, versus a taxable account, meaning your own personal funds. Now, I quickly went to the IRA Club website. We have on our resource page, we have these amazing calculators that I think everybody should utilize. But if you had a starting balance, let's just say, for example, and I told you, you're hitting 7% with Fidelity or Vanguard or Schwab, and you rolled over, let's say, $100,000. And a lot of people tend to just roll over what they want or a portion of their retirement account over to the IRA Club. So a lot of people do have 2 different accounts. Truth be told, I don't have anything against the stock market. I want everybody to realize that I don't have anything against the stock market. In fact, I made a lot of money in the stock market during the bull market run. So again, we have to look elsewhere because we know, or I feel there's some sort of correction coming. So I actually want Mark to participate just a little bit. So for example, if somebody had an account with Fidelity, Vanguard, or Schwab, and they rolled it over to the IRA Club, and they were looking at a potential turnkey investment at 123 Memphis Street. And Mark, is it safe to say, the average investment is somewhere around 100,000 with you if you were looking for a turnkey investment?
Yeah, the average investment that we have is $133,000 as of today, and we have properties that are as inexpensive as $75,000. So that's very, very doable.
Okay. So with that being said, if we rolled over 100, and let's just say your current age is 50 years old, because I really want to emphasize people that are looking to retire sooner than later. If you're in your 20s and 30s, you still have time on your side, and you should definitely be self-directing and creating double-digit returns. But you are looking to retire at the age of 62, for example, 12 years, very realistic. Your expected rate of return within the turnkey investment at 123 Memphis Street is 13%. Mark, is it safe to say 13% if we include the property management, vacancies, appreciation? Is 13% okay? Is that typical in a 12-year span? Can it be higher?
Yeah, I would say that's conservative. So I like using the 13%. I mean, once you take into account the cash flow and appreciation, and it can get even higher if you decide to leverage as well. So 13 is a good conservative number.
Even better. That's what I want to hear. 13 is a conservative number. By the way, 13 is very, very conservative in my personal opinion. But now we're looking at the marginal tax rate of 29%. I'm looking at 29% because most Americans are between the 22 and 24% tax bracket. I'm also including the state income tax. I understand some people that may be listening are either in Florida or Texas, where there is no state income tax. However, I'm in Chicago, Illinois, where it is 7%. Some people may be in California. I believe it's like somewhere around 13.3%. So I just took the average of 5%. Ultimately, you would have to break down those numbers. But if you take a look, in 12 years, that $100,000 at 13% would bring you in roughly $433,000 at 13%, which in my personal opinion is a hell of a lot better than 7%, but it gets better. Your IRA, because you did it within your IRA, it saved you $145,000 in that 12 years. So if you actually really do think about that, you did not make an expected rate return of 13%. It's more like around 25, 26%. So that's what you need to understand, the power of self-directing. Control to invest, to create double-digit returns. That is the best type or form of, and most gratifying form of, basically telling Uncle Sam, kick rocks. Kick rocks. But the process is also what I want to go over. As we mentioned, Mark and said those kind words about the IRA Club. It's done in 3 simple steps. Most people feel like it's very complicated. It isn't. It's open, fund, invest, done in that exact format. It's $195. It takes 8 minutes. One of our IRA Club specialists will literally fill it out on your behalf. All you have to do is sign. You have to next fund the account. You could do it with a contribution of $6,000 if you're under the age of 50. If you're over the age of 50, you could do 7. You could do an IRA to IRA transfer. As I just mentioned in one of the slides, you have these funds already available, especially because this pandemic, all right? The other thing that you could do is a old employer rollover, all right? Your old 401k. Now, I do understand, I do meet a lot of people that rolled their old 401k with a new employer. However, because it is within 1 year, I would highly, highly recommend that you get a hold of your HR company and see if you could pull a portion of those funds out into a self-directed fund and use that to invest. Again, another way to protect yourself against inflation, taxes, and on, and also the volatility of the market that may be coming shortly. And lastly, invest. Just choose your investment. All right. In this case, we're talking about real estate. So I actually do want to talk about something that I promised Mark and his team and people, investors, clients, throughout the years. We have attended over 400 plus live symposiums, conferences, and I'm not talking about live streams or webinars, but where we're physically educating people, from anywhere from 200-300 to 1,000 people at one time. And we've set up, tens of thousands of one-on-one consultations where we listened to what these investors had to say. Number one, they were more so deterred about the process. They were worried that it was too difficult. So what we ultimately did was we created something after the pandemic and we were no longer able to travel, called the IRA Club Investors Kit. And ultimately what it is, it's a step-by-step video series. And what we're doing is we're going over every topic of discussion regarding self-directed IRAs, from partnering, from Roth conversions, fee structures between traditional brokerage firms versus a self-directed IRA company like us here at the IRA Club, into the actual physical process, navigating our websites, prohibited transactions, on and on and on. And what we want you to do is write these questions down. You will receive a 15-minute phone call where we'll answer the questions on your behalf, but we also want to practice what we preach by giving away a free IRA account. Remember, education is the key to success, right? You have to take risk, but it's taking educated, calculated risks. And that's what the Investor Kit provides. It's an educational guide. That's exactly, in a nutshell, what the Investor's Kit is. But I'm going to take it a step further from you, just because I believe in not just the Memphis investment team, but also what we do and what we preach. We will offer you this Investor's Kit for $1. you will receive the videos, the white glove experience, the free IRA account, forgive me, for $1. All you have to do is go to the IRA Club website, iraclub.org, hence, again, the educational side of it. We're not a call center. You have any questions, you feel free to reach out to us. We will completely walk you through this process. You will then go to the IRA Club Investors Kit link right on the homepage. You will click on that. And when you want to purchase the kit, you will simply put in the promo code, all in caps, Memphis, and you will receive it, if you see it highlighted here, for $1. You will receive a course curriculum where we will literally walk you through every single video. You will receive a phone call from one of the IRA Club specialists that will be your main point of contact, and we will help you with the investment team through the entire process again. I hope this has been very beneficial. If you have any questions, you want to feel free to reach out to me. It's Ramez at iraclub.org. Our telephone number is 312-795-0988. Again, Mark, I want to say thank you to you and your team. You guys have been fantastic to work with. I hope everyone got a little bit of something educational about how to use your retirement account. And ultimately, this is such a great way to not only take care of yourself, but also to take care of your family. Thanks again, Mark.
Great work. Great work. You know, Ramez, I love what you said is education is the key to success. And that's the whole reason why we're here at the SOFA Summit. And that's what I love about the IRA Club and the fact that you guys are giving away that investors kit, which is really just there to, you know, teach you the exact process and, you know, the pros and cons to make it easy to actually create and self-direct your own retirement accounts. Because at the end of the day, we're just here to teach you different options, right? And to let you know that you don't just have to invest in the stock market in your retirement account. You can invest in single family turnkey real estate. And the process is very simple and easy and inexpensive. You just need to have the right team in place. And that's exactly what we've figured out, is that Ramez and Dennis and the IRA Club, they're absolute legends in the space. And, you know, people, you know, that we trust. So definitely reach out to them. You know, if you have any other questions or want to get their contact information, again, happy to pass that information along, and hope you enjoyed the session. Thanks, Ramez.
Thank you, bud. Thank you, sir.
Hey guys, Mark Hart here from MIP. Welcome to the next session for the 2021 SOFA Summit. This session is called the Property Deep Dive and Neighborhood Tour. First, we're going to start off, and I'm going to take a deep dive into one specific property. We're going to go over the Google Drive folder, and in this folder, this is the marketing material that you'll be able to view on your own for every single one of our available rental properties. So this is the information that you'll use to make an educated decision to see if you'd like to move forward with the home or not. So I just kind of want to walk you through it from our perspective, just so you can understand it a little bit better. And then once that's completed, we're actually going to go visit Sean, who's actually at the property. He's going to give you a little walkthrough of what the home looks like before renovation. So when we actually bought it, and then you can see the finished product as well. It's great to see that transformation. And then finally, best of all, we want to bring Memphis to you. So we're going to drive around the car a little bit so you can actually see the tour of the neighborhood. So you get to know the difference between an A, B, or C class neighborhood here in Memphis, Tennessee. Let's dive in. All right, first things first, always like to type in the address and pull it up on Google Maps just so you know exactly where the property is located within Memphis, Tennessee. 5590 Mill Branch Road, Memphis, Tennessee, 38116 is the property we're going to take a deep dive into today. And that is located in Whitehaven on the southwest side of town. It's actually a couple of streets over from and very close to the border down here of Mississippi. So this is the state line. We can zoom in a little bit here. Some of the reasons why we chose this property and we really like this as a rental. Number one is its location to the airport. So once again, this airport here, Memphis International Airport, is the location of about a third of all jobs in the city. So a lot of tenants want to live in close to work. Then this area is also called Whitehaven, Tennessee. This is where Graceland is located with the king himself, Elvis Presley, which is really fun. A lot of tourist attractions around Graceland there. And then also the property is right there on the border to Mississippi, which this is South Haven, which is an A-class rental neighborhood. And since it's right on the border of South Haven, our property here is going to be in a B+ location here. So we're going to take a deep dive into a B+ rental property here in Memphis, Tennessee. Next up, I always like to open up the Google Drive where we have all the marketing material needed to make an educated decision on the property. The very top here is where we have our photos. This is where we'll have our pre-renovation, progress photos, and professional photos once the renovations are completed. We'll actually go to this property and see it firsthand as soon as we're done with the deep dive here. Next up, I always like to quickly look at the pro forma here. And from a high level perspective, you've got the price, $119,900. That does include the renovation. 3-bedroom, 2-bath, about 1,200 square feet, built in the late 50s. This property here is a carport and a garage. C is carport, G is garage, and it's located in a B+ neighborhood. So it'd be really great to take a deep dive into this B+. We have bolded the high level and most important items of the pro forma. The first one is the target rent, $950, which we're renting these properties before our investors are actually closing on the homes, resulting in cash flow from day one, which we're really proud of. Then the cap rate or the all cash purchase, about 6.62%. Then your net cash flow monthly, assuming a 20% down mortgage. So this is the big one here, $225 per month or $2,700 per year is your projected cash flow net that you can save. You can spend it on a vacation, but hopefully you reinvest in more rental properties. And to compare this investment with another investment is where the cash on cash return comes into play. That's every dollar that you had to spend to buy the investment, which is your initial cash invested, or $27,230, divided by your annual cash flow, which is $2,705. And that's going to give you a percentage of 9.9%. You can think of that as comparing it to a dividend and or a stock. And it also allows you to compare, our property here with the property in California or all over the country, or the world. One of the biggest things to make note of is you want to make sure that the closing costs are included in your initial cash invested. Some people leave that out to make their numbers look better. And you also want to make sure that you're including vacancy reserves and maintenance reserves as well. You want to take that into account when you're projecting your cash flow. Just another way people can inflate the numbers to make them look better. So we want to be as conservative as possible, but also as realistic as possible. And that's where these vacancy and maintenance percentages come from, is our real data here in Memphis, Tennessee, and with our property management company. So if you add up all of the different ways you can get a return, your cash flow, the appreciation of only 2.5%, which is an 11% ROI. That's why real estate's amazing. Mortgage principal reduction, right? The tenant pays down your mortgage, 6.6%, and tax savings ROI, right? You get to write off the expenses, you get depreciation, you get a lot of great tax write-offs. Not a CPA, so make sure you reach out to yours. And you add it all up, it's about a 30.9% ROI. And what we love about real estate is, Memphis appreciated 14% last year. So if you multiply that by 5, that's what your ROI is, assuming you put 20% down. And that's where the numbers just get really, really fun. So that's the pro forma here. This property, $120,000 price. If you put 20% down plus closing costs, that's initial cash invested. So $27,230 estimated out of your pocket. And then you should expect to have roughly $2,700 per year in cash flow and a total of $8,400 per year in equity and cash flow combined. So not bad there for a passive investment. Then next up, I always like to take a deep dive into the scope of work. This is our high level scope of work. We also have a more detailed one. This is the one where we just focus on the items that people like to forget, like the expensive CapEx items. So for us, we like to focus on them and put them front and center because we're really proud of the renovations that we do. We did about a $30,000, $29,000 and change renovation on this property here. And it's got all new roof, new heat, new air, new water heater, right? That means we actually spent the money and installed a new item there, which does have a 1 year, our entire renovation has a 1 year construction warranty, which means that anything that we've actually renovated and we actually touched, if that breaks within that first year, then we will fix it for free. Flooring, all hard surface, right? Once again, you never buy a rental where the main floor is carpet unless you want to just have really high expenses moving forward. And this one, dishwasher, yes. Vent-a-hood, yes. No range and no fridge. And when there's no range, no fridge, that means the tenant will bring their own and you do not have to worry about that expense. Then there's some more frequently asked questions here at the bottom, which we'll dive into some of them. The tenants are responsible for performing basic lawn care. So essentially that's another way we can reduce your expenses there. You know, we don't require them to plant roses and trim the trees, but they're the ones that's required to cut the grass and keep the property in good shape there. If they don't, well, then the management company, Reedy, will cut it for them and just bill them directly. The tenants will put all utilities in their personal name and pay the utility company directly. This is one of the leasing criteria we have, is that the tenant has to be in good standing with the utility company before they can actually qualify to move into one of our rentals, because they will have to put the utilities in their personal name. Now, the exception to this rule is if you do invest in Mississippi. In Mississippi, there's different utility companies and some of them will go directly to the owner and then get reimbursed. All of these things is what we will handle for you on your behalf. But for the majority of our properties in Memphis, Tennessee, you won't ever see that bill. It goes directly to the tenant. The tenants will bring their own appliances and pay to maintain. This is the big one, right? Is that it's just less, these items get used every day and they're really expensive. And it's just one less thing that you have to worry about. Another way we can increase the cash flow. And it's the norm here for Memphis, Tennessee, which is wonderful. We utilize 24-month leases with a 4% rental increase between year 1 and year 2. And annual leases are rare, but on a case-by-case basis. This is incredible because essentially, let's say the rent is $1,000 per month year 1. That means year 2, it's going to be $1,040. And where it gets really fun is, let's say your cash flow is $200 per month year 1. Well, year 2, it's now another $40, $240. It's a massive increase in profit from year 1 to year 2, which is one of the big benefits and reasons why we do these leases. Then on average, our appraisals come in over sales price, resulting in $2,300 in equity. So we've got a lot of data on appraisals because we do roughly 30 houses per month. And about 75% of all of our appraisals come in over value. There are those that come in under, about 25%. And that's just the luck of the draw in terms from an appraisal standpoint. We've seen appraisals vary $20,000 low, and then you get another appraisal and it comes in $100 high right after. It just doesn't make much sense. Then moving forward, weather, permits, and code enforcement damage to the property unforeseen could cause delays in our target completion date. So this is a big one. This is construction, right? We're going to have an estimated completion date, which will be right at the bottom of the photo here for you, but that's not a hard date, right? That's a soft estimation. Expect that date to change. It's virtually impossible to project from the beginning of the renovation when it's going to be completed. We will keep you updated every other week with the progress. We'll let you know if the completion date changes. We'll send you some progress photos so you can kind of follow along. And it's kind of fun to watch the property go through the renovation stages on a weekly, bi-monthly basis. All right. So then you can keep reading on there. You can read on for days. Those are just the main frequently asked questions we have. Then this is our detailed scope of work, right? This is going to include the major CapEx items, which make up the majority of any renovation, but this also has the additional cosmetic items as well. And the smaller items like, oh, we're going to do some carpentry work to repair the gate and repair any rotten wood outside. We'll pressure wash the house, have a dumpster, security doors, so on and so forth. I do want to note that this is our original scope of work on the house. This scope of work is subject to change from a smaller cosmetic standpoint. The major items like the roof and the HVAC, the water heater, the floors, all of those items, are set in stone. All right. Next up, we have the MIP purchase process checklist. So if you do want to follow along step by step and start checking off all the boxes to make sure you're on the right track, you can definitely do that here. And then finally, this is a copy of the MAR data and the Memphis Area Association of Realtors data. It's something that we have access to as realtors, and it's just a high-level summary of all of the public county records for the property. So it's great to go through and see the summary and the lot size and the parcel information, the taxes over the years. It's good to see. You can also see the assessed value and appraised value, if it's in a flood zone or not, right? Don't buy properties in flood zones. What you would see here, the zone code that is a code red for a flood zone would say AE. That would be the one where your blinder should go off. If it's in an AE zone code, that probably means you are required to get flood insurance, which is basically your cash flow per year. It's probably around $2,000 to $3,000 per year. So don't buy a property in a flood zone unless you're getting a really, really, really good deal. And then finally, since this is a property that we've already completed in the past, we've gotten a home inspection where the report will be located here. And then we will also give you a repair punch out list to where the home inspector will go, and there's always 5 to 10 items that will show up on the report. And we give that report to our construction team, and we'll make almost every single one of the repairs. And if there are some that we won't do, it's all a negotiation, right? So you have to be 100% satisfied with the condition of the work. And for the items that we do agree that we're going to complete, which is almost all of them, we'll give you a fun little Word document here so you can follow along, and then it allows you to be able to actually see, what we've done. All right. So that is it for the Google Drive here. Hope you found some value in that. Now we're going to go see Sean, who's actually at the property, and he's there and done before, during, and after walkthrough videos, so you can see and follow along. So one, you can look at these photos here, but we want to actually show you in person with video. And then 2, he's going to give you a tour of the neighborhood so you can see what a B+ neighborhood in Memphis, Tennessee really looks like. Enjoy.
Hey everyone, Sean Taggy here. Super excited to be showing you our new property we just acquired, 5590 Mill Branch. We will put up all the property details, bed, bath, square footage right over here so you can check it out. What's interesting about this property, it is about 5 houses down from the state line. So we're in Tennessee right now. You go just a little bit down Mill Branch, busy street, and you get into Mississippi. So pros and cons to living on a busy street or having a rental on a busy street. Pros are you get a lot of traffic, so you actually probably rent the house a little bit quicker. Cons, there might not be quite as many tenants, maybe like family tenants who want to live here because it's a little busy, but I mean 50-50, depends on if it's gated in the backyard and farther away. Like this house is pretty nice because it has a fence around the whole front, so you can lock in the kids, so not the most terrible thing there. So yeah, this is a great house that we just purchased, so let's go on in and check it out, see what it looks like before. So one thing I really like about this house is it has a carport / garage. That's an extra bonus feature, definitely helps out the rentability, having some sort of covered parking, and this just cherry on top, it has both. So coming along inside, grab that, Rich. So this was an inherited house. So the previous person died in this property, and just the kids inherited it, and they're like, we don't know what to do with all this stuff and everything like that. And we just stepped in. And we're like, look, we'll take care of everything for you. Take what you need, and we'll take care of the rest for you. So that's a nice thing that we offer to people, is just, when they're dealing with a sticky situation like that, we help them out. And obviously the kids didn't have the time or the money to put in to fix up this house. It's obviously just outdated. It's pretty well taken care of comparatively. It's just been lived in for a long time. So we're gonna have to pretty much renovate everything in here. So a lot of carpet, just some old stinky carpet in here. Let's check out the kitchen. So functionally wise, we're probably just going to come in here, do a full renovation with pretty much everything. And yeah, just going to put in all new appliances, things like that. A lot to kind of renovate in this kitchen. The floor as well. I mean, I'm not seeing too much like structural issues or crazy plumbing issues in here, but we're gonna have to do a full renovation. We got a lot of wallpaper around the whole house, so we'll take that out. So coming along here, got one of the bedrooms. We'll see what it looks like during and after, and we'll kind of show you along the progress, but here's what it looks like before. Quite a bit to reno. Something we always check, water heater. I don't know exactly when this one was built. We'll kind of go around here and you can see that water heater, what it looks like before. We'll let you know if we're changing that one out or not. Our motto is if it's, I believe, 10 years or older, we're going to replace it. So I don't know the exact serial number and all that on that one. Then we got the heater. This might be running pretty okay how it is. Yet again, we'll just check the HVAC system, how it's running. So here's another bedroom. Yet again, just old carpet. We're going to probably put in stick down floor, repaint in here, new fixtures, light fixtures, everything like that. All right, here's the third bedroom, which is also the master bedroom. So yet again, carpet and all that. We're gonna take that out and flooring. So a little tricky, this is actually a bone, not, even though it's a small bathroom, it's nice. A nice feature for the rentability. 2-bath houses rent a little bit quicker. The families, the parents want to have their own place to shower and all that. So we're probably going to come in here, renovate this bathroom. Quite a bit to do on here. Definitely outdated and hasn't been fixed for a while. And wrapping back here into the living room. So we'll take out all these things, but yeah, that pretty much sums it up. Let's see if we can run around the back and check out the backyard with you. So we're going to fix this siding here, remove any rotten wood or anything like that. You can kind of just pan through this backyard. It's nice, we'll do a little cleanup here. There's a little stream, but we got a nice fence in there to block out anyone. We'll probably be replacing that AC over there. It looks a little bit older. Probably some rotten wood and things like that. Looks like the roof is going to need some replacing or some fixes here and there. But yeah, that pretty much sums up this house. It'll be a great little rental house once when we get our renovation fully done on it. So yeah, guys, we'll be following along the during and after on this property. Be sure to keep checking us out. And thanks for everything. Have a good one. All right, everyone, 5590 Mill Branch we are at here in South Haven, Mississippi. As you recall, this property was filled up with a lot of belongings from the previous owner. So it's been about 6 weeks. Let's go check out our finished product. This property is already sold, doing the home inspections and appraisal. Let's all go hop on in. So we did a paint of the exterior, just kind of freshen up the property, making it look nice. And put some paint over here and on the driveway, I guess, to, you know, seal up some of those cracks and everything like that. So just a fresh, new looking renovation. We got our nice luxury vinyl plank, hardwood looking floors, scratch proof, tenant proof, resistant proof. I'm gonna shut that door real quick. So this little den area is really nice now, nice and clean and safe. Some good storage here for the tenant, whatever they feel like placing in there. And just a nice cosmetic freshen up paint and everything. So coming around here into the kitchen, we got our nice Formica countertops, repainted the cabinets, new stainless steel knobs on everything, making it just look nice and fresh and popping. All the lights, plugs, and switches are changed out as well, just make things look nice and fresh and everything like that. New washer and dryer, little hookup things right there as well. So we're popping into one of the bedrooms. Obviously we just kind of work around the floor plan in the house as best we can. But a good little rental for this area. And, you know, a great value for the tenant, for the price. Definitely one of the best looking rentals inside in the neighborhood. So stepping around here, you can check out with the bathrooms, new tile up there, going across. Nice new vanity, fixture, toilet, everything like that. And you can pop over here, we got a nice new water heater. The HVACs, I think that's newer as well. So we always check those and everything like that. Big value to you. You can get that on a loan at 20% down instead of paying all that up cash 5 years later when it goes out. And these will last for a long time for you. Here's another bedroom. Not much to say, just, you know, nice, clean, safe. A little closet there, you can peek around in there. Turn that off. So here's the master bedroom. And it does have actually squeezing in a second full bath in there, I guess 3/4 bath, technically speaking, shower, tiled up shower, new fixture, toilet, new vanity. So just a decent little rental. Let's pop around to the backyard through here. You can kind of scan through there. So what's nice about this house, it does have a carport and then a garage kind of tucked away in the back. We put in a nice new AC cage. And yeah, this is pretty decent space, pretty decent backyard, I would say. So yeah, this property's on Mill Branch Road. I guess I discussed that a little bit last time, but just barely north of the border into Tennessee. If you go about 2 minutes down the street or a minute down the street even, you are in Mississippi. So yeah, really love this area. Another great area, another rental property brought to you by Memphis Investment Properties. Thanks so much for checking us out, guys. On to the next property. Have a good one. All right, guys. Well, wrapping up day 3 of the
Woo, what
Sofa
a day.
Summit.
All right.
If you are not cash flow kings right now, I don't know what else we can do for you. Just kidding. We got 2 more days going on tomorrow. Anyways, wrapping up today, kind of my thoughts. With Aaron Chapman's talk, I really liked just understanding how inflation is to our advantage when you're investing in real estate, right? Because, like, you know, your mortgage is locked in for 30 years and everything like that, but your rents are going up.
Mhm.
So, you know, rents are $1,000, maybe in 2 years they're $1,050, and in 30 years from now, who knows what they'll be. But you still have the same mortgage payment that's fixed there. And the dollar is worth X this year, but it deflates whatever, 3 to 7 to 12% every year. And so you're paying less deflated value of those dollars on that same fixed mortgage. So it's really a disadvantage to the lender, and we should take advantage of that. So yeah, I really like that, learning about that, and having a whole different perspective on real estate investing.
Yeah. Love it. I think my favorite part is Zach's talk. I mean, one of my favorite parts about this entire business is the relationships that we get to build. And that's why we're here, right? To help you guys accomplish financial independence and have the best time along the way. So you're the man, Zach. I'll see you on the golf course.
Yeah. Thank you, everyone. Please be subscribing, liking our channel, letting your friends know about this. We are on tomorrow at 1 p.m. Central Standard Time.
1 p.m.
So that'd be 11 a.m. Pacific Standard Time. So yeah, we excited to see everyone tomorrow, and we will see you on your way to becoming
a cash flow king. Woohoo!